What are the prospects for crude oil prices in coming months? To objectively analyze future oil prices, we have to take a look at the oil price action during the last 2 years. The following infographic shows that the oil price has seen the biggest gains among different assets since the beginning of the pandemic. Overall, in the last 2 years, primary commodities, especially energy, performed the best. And as nothing rises forever, any sharp uptrends must eventually come to an end. Here we can see an oil chart since the market crash in March 2020. The price of the oil future market in 2020 has fallen almost to zero. Then, 2 years later, in March 2022, it skyrocketed to $120. Since March 2020, there has been an unbelievable 92,600% growth. What can I say? Even cryptocurrency is jealous about that return on investment. Such a dynamic and aggressive bull market needs a correction. Technical analysts agree that this price increase may result in a correction of up to 50%, which would give us a price of oil at around $60. But we should still keep in mind that this would be just a correction in a bigger bull market cycle. Okay, so I talked a little about the oil price action. What does the situation look like from a fundamental standpoint? As you can see on the chart, crude oil prices have been falling already for about 4 months. What happened in the meantime? First of all, inflation. Inflation in the US hits a 30-year high. You may ask, what's the connection between inflation and crude oil prices? Let me explain. This huge price increase in commodities, including oil, were mostly fueled by printing money. On this chart, there is M2 money supply. As you can see, in 2020, there has been more dollars printed than ever before. Dollar printing has started after COVID market collapse in March 2020. There was no other way to save the economy after COVID changed our lives. The US government launched the Stimulus Rescue Plan. It was meant to help citizens dealing with new difficult situations and job loss. Helicopter money was given to people in the whole US. The central bank began purchasing long-term securities from the open market in order to increase the money supply and encourage lending and investment. This process is called quantitative easing. QE, quantitative easing, caused all the assets to increase their value. Stocks, commodities, cryptocurrency, real estate, everything. There was a surge of prices on all the markets. Money printing caused rising inflation, which hasn't been seen in the US for 30 years. The Fed is doing its best to resolve the inflation problem. In June, Federal Reserve Chairman Jerome Powell told lawmakers that central bank is determined to bring down inflation, even though he acknowledged that recession could happen. Achieving a soft landing in which policy tightens without severe economic circumstances, such as a recession, will be difficult, he said. To fight inflation, we need to raise interest rates and start tapering. What is tapering? Tapering is the reversal of quantitative easing. Tapering refers specifically to the reduction of central bank assets. This action fights inflation, but on the other hand, it's very bad for markets. It causes assets to crash. Additionally, less money in circulation equals the equity market going down. Tapering started at the beginning of this year. Results we can see on the stock market, commodities and crypto. All assets go down and crude oil is among them. When may we expect the end of this downward spiral? Tapering is planned to be performed till 2023 or even 2024. At the end of tapering, we can anticipate lowering interest rates. Low interest rates stimulate the economy. Companies now can take low interest loans and invest. People don't save money on accounts because interest is low. When we have low interest rates, money is circulating and the economy is blooming. But remember that the dates I mention are just an estimation. The Fed will adjust its plans according to market circumstances. On this chart, we can see ING forecast, assets on Fed's balance sheet in orange and interest rates in gray. This prediction would assume that the Fed will keep on selling their assets to pull the money out of the market. Now we have 2.25% interest rates. According to this prediction, we will see some more hikes till 3%, keeping it for months of 2023 and lowering interest rates in 2024. Another source, Vanguard, and the same prediction. According to Vanguard, in September, Fed will speed up selling assets. The big question is how the market will respond. Of course, we may assume how the market will respond. These are conditions that can result in a serious and prolonged bear market. In coming months, Fed actions won't support market growth. It's very probable that we are entering into long recession. At the beginning of the war in Ukraine, we could think about crude oil prices going up. It would make sense, right? Lower supply and high demand. But Russia found other markets and it's trading with Saudi Arabia. Sanctions do not affect Russia's balance sheet when it comes to selling oil. At the very beginning of the war, crude oil prices indeed increased, but it was just a speculative fake-out. Sanctions against Russia push Europe into thinking about its energy independence. There are some gossips that China could become a potential market for Russian oil. But it isn't clear how the Chinese economy will look in the coming months. They struggle with lockdowns, protests and supply chain crisis. Dan Yergin, an energy expert, says that the oil demand outlook for China, the world's largest oil consumer, is also uncertain. China has slowly reopened part of the country that were recently locked down due to spikes in COVID cases. It's unclear how quickly Chinese businesses will rebound from restrictions on economic activity. Many economists now expect a slow economic recovery ahead due to far more transmissible variants, weaker growth, and less government stimulus. The extent of the recovery and reopening will have an impact on oil demand. That uncertainty has held the oil prices from going higher. How do high oil prices affect petrol prices? First, we have to understand what makes up the price of petrol. There are a few components: oil, price, duty, taxes, refining, marketing and distribution. As you can see, the oil price greatly affects the price of petrol. Refining makes up about 25% of petrol price. As we can read on Capital.com, the gasoline price benchmark surge is driven by elevated crude oil prices and widening gasoline crack spreads on the back of diminishing refining capacity, wrote Dominika Rzechorzek, oil and gas analyst at Fitch Solutions. At this moment, not only is the oil price rising, but the refining costs are up as well. As always, experts have different outlooks on future oil prices. Kiplinger, a Washington DC-based publisher of business forecasts and personal finance advice, noted that record-high gasoline prices would be unlikely to see a significant drop. Dominika Rzechorzek has different outlook on gasoline prices. She said there is downside potential on this year's gasoline predictions from weaker than expected demand for the fuel due to lingering movement restrictions in China and weakening economic growth elsewhere. Rzechorzek also noted that a decision by US President Joe Biden on 31st March to release stocks from the strategic petroleum reserves may have some impact on gasoline prices. So to summarize, in the coming months we can expect a stable petrol price. It is highly probable petrol prices will fall lower. The cause for this is economic stagnation. People have less money, so demand is lower. Unfortunately, the long-term outlook isn't that optimistic. At one point we will see higher highs on the oil chart. Maybe you should think about buying a bicycle. I don't know. Thank you so much for watching. Please give us some thumbs up, leave comments below and subscribe to the channel. See you next time. Bye.